I'm Michelle Makori. Thank you for joining us. Inflation is still hotter than expected. The consumer price index rose 0.6% in August, its biggest monthly gain of 2023. And year-over-year CPI rose 3.7%, with rising energy prices largely responsible for the increase. Now, core inflation, which excludes energy and food, was up 4.3% year-over-year, a drop from July's 4.7%. So what does this mean for the Fed's fight against inflation, Jerome Powell's next moves, the economy, markets, and gold? Let's ask Axel Merk, the President and Chief Investment Officer of Merk Investments. Merk Investments has over $1 billion of assets under management and offers advisory services on global equity markets, fixed income, commodities, and currencies, with a strong focus on gold and publicly listed gold companies. Axel, very good to have you with us.
Good to meet you.
Okay, let's start off with the inflation that the Fed has been trying so hard to contain. So August inflation climbed the most in 14 months. The consumer price index increased by 3.7% year over year. And that's a rise from July's 3.2% that was higher than the forecast of 3.6%, largely attributed to a big spike in energy prices. Core inflation, which excludes food and energy, that was up 4.3% year over year, and a drop from July, which was at 4.7%. And energy prices, a big deal here. They were up 5.6% on the month, and that increase included a 10.6% surge in gas prices. So great that the data can exclude food and energy, but that is really not much consolation for those paying at the gas pumps and at the grocery store. And headline inflation also really hitting worker paychecks, real average hourly earnings declining 0.5% for the month. So overall, Axel, what is your read on the data and the Fed's reaction?
Well, mission accomplished, of course. We live happily ever after. Ultimately, the context is, of course, that we have a Federal Reserve that, in my view, does not have a strategy. The Fed says they want to be higher for longer, and somehow we're going to get lower in inflation over time. Yet they have made it very clear that they don't really want to hike rates further. John Williams, the New York Fed president, said the other day that, well, restrictive, we don't know whether we're sufficiently restrictive. Then when he was asked about potentially high inflation numbers and potentially a little stronger economy, he kind of shrugged it off and says, well, of course, it's a risk, but let's not get ahead of ourselves. So, and then the context is, we had a supply shock. We had very high inflation. And what people tend to forget is that any adjustment process is not linear. And so, whereas we are glued to the next inflation release, the next one could be higher, could be lower. We don't quite know whether we'll be, quote unquote, done. And what it ends up with is that we have a Federal Reserve that's kind of sticking to where they are right now, hoping that somehow things will, quote unquote, normalize. You mentioned high energy prices, right? There are a gazillion reasons why energy prices are high and can throw a curveball into where we are. We have a war in Ukraine, we have supply issues and whatnot. And so all of that is, I think the technical term is a bit of a mess, but what ends up happening is the Federal Reserve is going to do nothing. And so if you look at the trading day when these numbers were released, first the market was all excited that they were worse than economists had forecast, and then it fizzled out. It fizzled out because it doesn't really matter what we say. It matters what the Federal Reserve does, because they control the bazooka, and they don't want to do anything unless something radical happens in the markets.
Well, define what you mean by they don't want to do anything. I mean, do you mean that they don't want to continue to raise, or they don't want to cut? Like, what do you mean by they don't want to do anything?
Well, if you're not confused, you haven't paid attention, because the Federal Reserve, I don't think, knows exactly what they want to do. Okay. Powell, if you listen to his Jackson Hole speech carefully, he clarified that higher for longer doesn't even necessarily mean that rates will stay where they are. Because ultimately, they say that, well, as inflation potentially goes down, if they don't lower rates, then that means real rates will increase. So what I would expect the Federal Reserve in a few months or weeks even to say is that, well, we'll start cutting rates, but don't take that as us taking the foot off the brake, because the policy will continue to be restrictive. So that's one side of the equation. The other side is that by saying, quote unquote, higher for longer, historically, when we have the economy weakening, the Federal Reserve would pivot and ease. Well, this time around, their hands are pretty much tied because the ghosts from the 1970s are haunting them. And as a result, they'll probably be more restrictive for longer. And it's part of the reason why I don't buy into the soft landing scenario, because you don't want to fight Fed. Fed policy acts a lag. The Fed is ultimately a debating club, and when you're a debating club, you're not going to make decisive decisions unless a crisis is smack in your face, and that's why they were late in hiking, and that's why they'll be very late in easing.
Okay, a lot to dissect there. Let's start off with the most immediate moves from the Fed. That is the upcoming meeting, and the expectations there are that 95% probability, according to the CME FedWatch tool, that the Fed is going to hold steady in this next meeting, about a 39 to 40% chance of a rate hike come November. Now, you said that they may start to change the language. Well, firstly, do you agree with them pausing at this next meeting? But it sounded to me as though you said that they may start to signal a forthcoming rate cut. Do you expect a change in the language then? What do you expect?
Well, Powell is fully aware that the moment he starts using different words, the market will jump to conclusions, start pricing that in. What the Fed should do is they should announce that they're going to completely revisit their communication strategy, because, again, higher for longer, what's the reaction function in that? What do you get from that, right? And if they don't want to say anything, well, why do they have a press conference in the first place? And so imagine just theoretically a world where we'd have a rules-based Fed, where interest rates would be set based on inflation and employment. We could actually try to forecast what those metrics are and figure out where the markets should be, where interest rates should be, rather than being zoomed in on a speech by the Fed chair. That would create less volatility in the market and much more clarity, which would be better for asset allocation. But what Powell will do at the next meeting, probably nothing. His goal will be to say nothing. We will try to zoom in on any mishap that he might, that could be read in between the line of Powell switching. Now, he did allude to, and Jackson Hole, and I think that was underreported, that yes, he's going to be focused more on real interest rates. So my personal focus is going to be, is he going to add nuance to that? Is he going to repeat that? And if so, maybe more will jump on that. And it doesn't take many for the market then to reassess where that will be. And then once that is then the common perception, the market, I think, will price in more rate cuts for next year.
Okay, so you think he is not going to hike rates again for this year?
No, not unless something dramatic happens. We have already seen, I think John Williams, who is one of the folks at the Fed who has more influence, he said, let's not get too excited if economic numbers come in better than expected. The inflation print being higher than expected and definitely much higher than the 2% target, I don't think affects them too much, because there are various corners of the economy that do show signs of weakness. There are areas that don't. If you have locked-in mortgage rates, or if you are a cash-rich and cash flow generating company, of course the higher rates don't affect you, but they start affecting the consumer. They obviously have started to affect quite significantly so the banks that I think we'll talk about later. And so there are increasing headwinds. And then one area that we don't talk about much is both Europe and China have substantial challenges right now. And there's a saying that the US economy can do okay if one of those places has challenges, but not if both. And so in addition to, and then finally we have some of the COVID policies finally run out, some of the last ones. So all of that adds up. And there's a cumulative effect to the tightening as well. So the Fed, using their words, is they just rather want to watch the data rather than do anything. And so unless something really bizarre happens, I don't think the Federal Reserve will continue to hike rates. And back to your question of what I would do, well, I would revise the entire approach to policy setting. The exact setting is less relevant than what the economists call the reaction function, right? Telling the market what the Federal Reserve is going to do. And the reason this matters, and I'd like to remind people that don't think too highly of the Fed, is they control the bazooka, and you may want to pay attention to those that control the bazooka.
Don't fight the Fed. Certainly need to pay attention to those controlling the heavy artillery there. Well, let's focus, though, on what we're getting from this immediate inflation data, right? Because we did see that, and you touched on it as well, energy was a big component driving inflation. You can exclude energy from core CPI in the data, but that's really no consolation to the people actually paying more at the gas pumps, right? So if the issue is energy, does raising rates help this? I mean, surely increasing the energy supply is the way to deal with this. And that means policy changes and regulation changes for domestic oil and gas producers and refiners, because the Biden administration has not been that supportive of domestic oil and energy companies, to put it mildly. So if energy is the big component of inflation, as we're seeing it is, how does raising rates even help bring that down?
Of course it doesn't. And the best cure to high energy prices is high energy prices, because the high energy prices will reduce demand. By the way, in some corners of the world, they're increasingly subsidizing energy. If you take Germany, they have intense debates about subsidizing the cost of energy for industry. On the one hand, everybody wants to have the green policy, and then the economy falters, and they're starting to subsidize folks. So the more you intervene in these markets, the more dislocations you create. And of course, in the US, not just do we inhibit exploration on the oil side, but we have a state actor, the government, allocating assets to specific ways of transitioning to the green economy. Historically, only China used to do that. But it appears to have become fashionable in the US and Europe. And so what that means net is we'll have less output, we'll have a higher cost of energy, we'll have higher inflation, less economic growth. It's not the end of the world, but these are all things that are counter to the goals that these policymakers have specified.
Right. I mean, it's one thing holding the bazooka, but if you're like aiming it at the completely wrong target, that's not really going to do much in the fight against inflation then.
No, but of course, I mean, the Federal Reserve, in their defense, they can't do much about energy prices.
Right.
But what they could do is that when you have a supply shock, as we had, right, they could have throttled down economic growth to bring economic growth in balance, and they didn't do that, right? So there is the Federal Reserve, the folks at the Fed know how to deal with a demand shock. They are not well equipped to deal with a supply shock. Right. And we've seen that obviously with the inflation that broke out.
Yeah. All right. So if the Fed and Jerome Powell hold steady, don't make any moves till the end of this year, what does that mean for the economy if we stay where we're at?
Well, to use John Williamson's words of the New York Fed, we are restrictive. We don't know how restrictive we are, but we are restrictive. And so we'll chunk along. Ultimately, right, the goal for the Fed is to be at 2%, and we're above 2%. And as long as the wheels aren't falling off, there's very little motivation at the Fed to ease. There is motivation if they see signs of a more pronounced slowdown, and if at the same time the inflation metrics continue to come down. Again, the problem is that if you don't have a proper strategy, and higher for longer not being a strategy, it's very difficult to see how exactly they're going to do that. And it's not just difficult for us as the observer, it's also difficult for the folks at the Fed. But what will happen, in my view, in practice, is that we'll have some inflation prints coming in weaker. And then once in a while, we're going to have a bad inflation print, simply because of the normal volatility of the data, and precisely because we're coming out of a high inflation environment. And what that means is that the Fed will indeed be quoted higher for longer, which means that we're going to have more volatility in the market. I think volatility is going to be a hallmark of these markets, because people are uncertain about what the Fed is going to do. People are uncertain about what the implications are going to be. And then slowly but surely, the consumer is going to erode. An economy that's very heavily dependent on consumer spending, I do think that more severe damage will be cost to economic growth than the market is pricing in.
Okay, so it's interesting that you focus on the consumer here, because that was the focus of a recent Goldman Sachs report, which was very, increasingly confident, rather, that the US economy is going to avoid a recession and will, in fact, pull off a soft landing. Goldman Sachs lowered its estimated chance of a US recession over the next 12 months to just 15%. A few months ago, it dropped the chances of a recession to 20%. Back in March, as that banking crisis was erupting, Goldman Sachs had a 35% forecast of a recession hitting over the next year. But now Goldman sees a soft landing. So they see inflation being brought down despite tighter monetary policy without pushing the economy into a recession. And the Fed has only achieved a soft landing once in the past 60 years. Nonetheless, Goldman Sachs thinks that this is an increasing possibility, and they're pointing to solid job growth and rising real or inflation-adjusted wages that should allow disposable income to re-accelerate next year. So in other words, paychecks will grow faster than prices. Consumers will then have the ability to keep spending. And in an economy where consumer spending is the main driver of growth, that's obviously very important. So what do you make of that call by Goldman Sachs here?
Well, I respectfully disagree with some of that. More important, though, none of us have a crystal ball. And the reason we talk about these metrics, of course, is because we want to make investment decisions. One of the prime reasons we want to make investment decisions is because that when we retire, we want to have enough money, and we want to retain and maybe even increase the purchasing power of our savings. And so when I look at any of these reports, I look at it in terms of risks. Right? What is the risk that Goldman is right? What is the risk that I'm right? And what is the risk that some other tail scenario is right? And maybe one of the most relevant one is that there's always the risk of a tail scenario. Almost every year, what really drives the economy and the markets is different from what was forecast just a few months before. So there's always the unknown risk. So we should think about that. I do think that the baseline forecast that Goldman has is ill-guided. Because I do see underlying weakness in jobs growth. I mean, the tech sector, maybe some of it is recovering because people are investing in AI. But by all means, we now, instead of having these quiet quitters, we have quiet firing where companies are reassigning people to different jobs. They're reluctant to lay them off. But we have fewer people that get part-time jobs. So these are all signs of weakness. Now, you can argue that it's all going to be soft and subtle. Part of the reason why I'm more pessimistic is because the quote-unquote transmission mechanism, as economists call it, has been throttled down. Because people have these mortgages that are locked in, there is less of an impact of the tightening. But it doesn't mean there's no impact. It doesn't mean it won't happen. As the economy is slowing a little bit and the market is pricing in a little greater odds of a rate cut, well, what's going to happen is that mortgage rates are going to fall. That means people are going to move to new homes, and that will allow home prices to move, and I think a little bit down in some areas. But more importantly, it will generate some of the more standard mechanisms that you typically have in a slowing job market. And then I mentioned, or alluded to it earlier, small banks are inhibited. They mismanage their interest rate risk, and on top of that, they have a bunch of commercial real estate that is underwater, where the homeowners are handing over the keys.
Yeah.
And what that means is that is another significant headwind to credit. We have some of these new private credit funds, but when you're a small business, you don't go to the big banks for credit. The big banks are not equipped to service small business. You go to the small banks, and the small banks will not be providing credit. And so to me, it doesn't add up. Now, maybe Goldman is right, and good for them if they're right, but I do consider the risk of a hard landing to be a significant one, and as a result, I do factor that in my investments.
All right. So give us the details of your macro outlook. You see a hard landing. You see a recession starting when?
Sometime next year. And clearly the economy has held up better than many have expected, but it will be presumably middle of next year. And that's, by the way, when the market is pricing in rate cuts that start in earnest. And by the way, that's just a few months before the election. And there is a saying that the economy does matter, especially when people feel that I mean, obviously, whether you feel the economy is doing well or not might be a political question. But when people are actually starting to lose jobs, it might spread to the so-called independents and middle of the road voters that do influence election outcomes, I think, more. And so I do think there's a significant risk or opportunity, depending on how you want to do it, of that happening middle of next year. Now, before we get too technical here, again, why are we talking about the economic cycle? We talk about the investments in a shallow soft landing scenario. Investors discount the slowdown, and risk asset equities tend to do okay. In a harder landing scenario, you have an earnings deterioration, you have equities perform poorly, and just a small hint that valuations are not exactly low in many places. And then, since we're on a precious metals types of channel, right, the price of gold tends to be very sensitive when the economy slows down because of the reaction at the Federal Reserve, and the gold miners tend to perform one of the best in scenarios where we have a harder landing. And so in that sense, it does make a difference for asset allocation. If you think we have we'll just breeze through in a soft landing scenario, you may be less interested in looking for other ways to diversify. But if you're concerned that either equities are too expensive or you don't want to be in other places, well, then you want to look at, well, is cash maybe a place to have a big allocation? And if you're more in the negative scenario, then in a harder landing, then on the gold mining side, there might be some interesting opportunities there.
Right. Before we unpack the opportunities there, just to clarify, so you see a recession starting in the middle of 2024. And by recession, you mean the technical term of a recession, which is 2 quarters of negative GDP growth. And at the same time, because of this, you see the Fed starting to cut rates. And also, as we gear up for the elections, and as the expression goes, it's the economy stupid, the Fed is going to want to cut rates, even though the Fed is technically supposed to be an apolitical organization, but we'll put that aside. The Fed will cut rates because that recession will hit in earnest by the second half of 2024. Is that?
Yes, almost. Yes, a few caveats. In the US, of course, we are in the unique situation that a bunch of bureaucrats decide on whether we're a recession rather than 2 quarters of negative economic growth. And so when I say next summer, that's when I think when the indicators that those guys are looking at will turn sufficiently negative that that committee will, with hindsight, declare a recession. And the Federal Reserve is presumably going to use as an excuse to cut rates that inflation has come down, and therefore, even though we're not at 2% yet, real rates have increased further, and they will continue to be restrictive even as they lower rates. And so we will have more mental gymnastics as to why a rate cut is not really easing. But the short of it is, yes, we will get some easing, I do think. And I do think that easing will be associated with a pronounced slowdown.
I want to get your thoughts on what we heard from the Chief Investment Officer at JP Morgan Asset Management, Bob Michel, saying that the Fed may cut rates as soon as year end as a recession hits the U.S. economy, saying the magnitude of the slowdown we're seeing across the board tells us that we'll probably still be hitting recession around year end, so they'll be cutting rates by then, saying such a move would be similar to how the Fed dropped its transitory call on inflation and started raising rates, he said. So he's expecting a complete turnaround here. And I just want to point out that we've had a lot of confusion and a lot of inconsistency from the big banks, including from what it seems like within the big banks, because we recently heard from JP Morgan's chief economist, who had a completely different message, saying that he sees continued expansion this year and modest subpar growth in 2024 as the most likely scenario, saying that the likelihood of a contraction has diminished in recent months. So a very different message from the chief economist and the chief investment officer at JP Morgan Asset Management. But what do you make of this call that they're expecting, at least Bob Michel is, rate cuts as soon as this year, as the end of this year. I mean, very different from what you just laid out.
As I indicated, right, if you're not confused, you're not paying attention. That's why everybody needs to make up their own mind. And I would encourage anybody to look in the world in terms of risks, right? None of us know. I don't think we'll get a rate cut at the end of this year unless the wheels are falling off, mostly because the Fed has boxed itself into a corner. And so they don't want to be accused of having a repeat of the 70s. And that's why they'll be late. That's why they'll be late in cutting rates. And by the way, we're already in September, so it's not that far until December. I don't rule out that we get rate cuts early next year. This year, I think, seems very optimistic. I think what we'll get instead is at some point, maybe it's next week, more likely later this year, just a talk that a rate cut would not actually be an easing. I think that sort of mental gymnastics is going to be square and center at some point in the coming months. When they'll shift to that in more earnest, I don't know. But because some of the economic data, yes, so there is clear weakness in some places, there's clear strength in other places. The Federal Reserve, because they're driven by a committee, I don't think dare to take that step to lower rates. Now, if we had a rules-based approach, we would have much more flexibility because we would know that we would just follow the process. But because we don't follow a process at the Fed that's replicable in any form, they're boxed in. And that is precisely why I think we're going to get a more severe recession, because they'll be quote unquote higher for longer and cause more damage along the way.
Okay, so now the question, as you've said, there's a lot of uncertainty, there's a lot of risk to mitigate. Nobody really knows what's going on. You are still saying that a soft landing definitely not looking likely, according to your forecast. So how are you positioning your portfolio? What assets will do well in the scenario that you're expecting?
Well, there's one thing I do personally, and then one thing we do institutionally. And simply institutionally, we have a bias towards gold mining because that's a mandate. And if we in our gold mining fund were to do something else, people would take the money away. But from an investor's point of view, the question is always whether traditional investments as a kind of 60-40 portfolio will protect you in what may be ahead. And personally, I continue to be at odds with a segment of the market that is pricing in euphoria when it comes to AI. Clearly, the late 90s showed that a euphoria can last a very long time. And so what it ends up being is that as an investor, what risk can you afford to take? Like some in your audience have substantial allocations to gold, for example, much more than the average investor has. Well, that is fine as long as you can afford the risk that in terms of dollars, it might come down if you can afford that risk. I'm in that fortunate situation that I can afford that risk. So my personal gold allocation is also substantially higher than that of many investors is. But that doesn't mean it's the right thing for everybody, in particular, since the price of gold is historically more volatile than it's been in recent months. And so people don't know where that may be. If you look at the gold mining side, the funding environment for the smaller miners has been difficult. So only the best companies have been able to access funding. If you look at the established producers, they have produced so much cash that they have much less leverage to the price of gold. And so it's not an easy environment if you dabble in that sort of space and where you want to be. We have the fortunate opportunity that we can be very patient with our investments, so we can support many of the smaller mining companies. But I mean, cash is an underappreciated asset, right? Right now, you're getting a return on cash, and so people who are concerned about investments, that's not a place to ignore. Keep in mind, for most investors, the goal is not to beat the S&P 500. For most investors, the goal is to retain purchasing power, to save for retirement or something along those lines. And so who cares if the S&P were to go up substantially if you're concerned about the markets and get a decent return on cash? It's really, you have to be comfortable with what you get in the context of the risk assessment, what's out there.
Well, in your forecast of seeing a real recession hit in the second half of 2024, what does that mean for equity markets, especially if you see the Fed taking rate cutting action at the same time? What is your outlook then for equity markets?
Well,
and we'll stick to the US.
Yes, historically, equities bottom 2/3 through a recession. We're not in a recession yet, and so I don't think we're at the bottom of that cycle by any means, right? You want to weed out the excesses of the boom, and some people are pointing out we haven't had as many excesses this time around than other places, but we clearly, in my view at least, we have clear excesses. In the AI craze, we have clear excesses with these 24 options that people trade. There have to be a lot more people burned before we can be, because from a market point of view, near bottom. And if we do have a hard landing, and then yes, traditional equities don't perform well, then gold miners do have an opportunity to perform well because they price in very quickly the perception of rate cuts. The funding environment in those scenarios, in a hard landing scenarios, if 2009, for example, 2008 is an example, tends to get much, much better. And these are, of course, extremely volatile stocks, some of them. And so it is a speculative space. If you go just to the metal side of things, the price of gold has held up very, very well, despite higher real rates, higher for longer. I do expect the price of gold to go higher when rates come down, in part because the price of gold has been very sensitive to weak economic data. It's had boosts on those days. That said, the one disappointment, so to speak, if I can dampen some enthusiasm just a little bit, is that in part because the price of gold has held up quite well as interest rates have gone up, it is a little bit muted on as interest rates come down. That doesn't mean I'm negative on gold on any imagination, but those who think that the gold space, there are often people who think that gold will skyrocket. There's, of course, many reasons why you can argue gold should be higher, but because gold has held up so well with high real rates, as interest rates come down, I think, yes, the price of gold will go higher, but it's not going to be, the volatility is going to be less on the upside than some people might hope for.
Got it. So gold is not going to be that sensitive to the first rate cut of, say, 25 basis points.
Yes, it will be sensitive. And of course, the media will jump on a 1%, 2 or 3% move, but it's going to be, I don't think it's going to be a 50% move or something like that some people are suggesting, right? There are always some people who are that enthusiastic, even though there are, of course, other factors that might be supportive. But I would think that the moves are going to be more in a historic norm.
So then what is your outlook for gold, let's say, ahead of your rate cuts of mid-2024? Where do you see gold being in the middle of next year before assuming the Fed then jumps in and starts to cut?
Well, the actual cut doesn't really matter. It matters, the perception matters more, right? And so the next critical point is when Mr. Powell will start talking about the rate cut. And again, my thought is he won't talk about the rate cut per se. He will say, if and when the Federal Reserve is going to cut rates, it's not really a rate cut because it's just to make sure that real rates are not going to come down, go high too much. The market is going to look through that, and that's when the price of gold is going to reprice higher. So on occasions like that, we can see a significant boost to the price of gold. The dampening I only gave is that let's say that we have a severe recession and we'll go down several percentage points. Because the markets are forward-looking, a lot of that will be priced in sooner. And some people will say, oh my God, why isn't the price of gold doing better than it is? And I can just tell people to be patient, right? The markets are there to frustrate investors, and they succeed at that very well over time. And so one just has to take it a step at a time.
Okay, so as things start to tank, people are already pricing in, you're saying, the action from the Fed. But give me a number here, Axel. I mean, what are we looking at? Are we looking at gold hitting a new all-time high at least, really breaching past 2,100 maybe by middle of 2024? I get not a hugely dramatic move, but a real all-time high?
As you point out, right, even 2,100 is, statistically speaking, not outside of the realm of possibilities. So by all means, that is possible in a supportive environment. I'm not there to jump on that yet. because the Federal Reserve hasn't made that pivot. I am a long-term investor in gold. I don't buy gold because I think tomorrow or next week or next month or early next year it will be at 2100. I buy it because of not only the long-term diversification benefits, but also because interests on the government level are not aligned with those of investors. So over time, purchasing power of the dollar gets eroded. Does that mean there can't be volatility in the price of gold? Well, not just there can be, there will be, right? And so I look at that as a milestone. Typically, when the price of gold soars higher, I don't like that so much, because then you have some momentum players jump in, and there will be a correction as well that may be significant. What I can tell is that if I look at the entire cycle that we've had, I don't think we're at the end of the bull market in gold, in part because the enthusiasm has been rather muted. We've seen earlier this year, we had a lot of new investors come in. In recent months, that's been fairly muffled. And I would think there's a good opportunity for investors to come back in and support the price of gold in the coming months as the Fed is gradually transitioning to an easier environment.
Right. Well, speaking of investor interest, actually, JP Morgan just put out a report saying that investor allocations to gold are at the highest in over a decade, the highest since 2012. So I definitely want to get your thoughts on that. I also want to get your view on a gold-backed BRICS currency. And I want to get your thoughts on this new proposal from the Biden administration to make mining companies now pay royalties of up to 8% on gold and copper. So we will do that right after the break in part 2 of our interview. Stay with us.